We're nowhere near bottlenecks. Just in terms of higher rates, I think this is probably one of the biggest risks out there for markets. And when most people think about higher rates, they think, what's the impact going to be on equities? I think they're asking the wrong question. We ought to be thinking about what's the impact going to be on fixed income? Because we know what higher rates are going to do to equities, right? We've seen environments before where rates have structurally gone higher. And I think that's where we are right now. I think the bond bull market ended in June of 2016. And in June of 2016, that's when the 10-year Treasury yield hit 1.35%. You had max bullishness. You had a triple B minus rated issuer in Europe issue a 10-year corporate bond at a negative yield. It was oversubscribed. How do you think that's going to end? A year later, you had Argentina come out with a 100-year bond. If you know Argentina's history, you know they've defaulted 6 times in the last 100 years. They're probably going to default 6 times in the next 100 years. They might even be defaulting right now. Who knows? But that was oversubscribed. And what you saw in June of 2016 was like March of 2000 for stock investors. It was maximum bullishness, right? You remember what March of 2000 was like. You remember the NASDAQ, you know, NASDAQ 5,000, whatever it was, when people said it's going to go to infinity.